Hey IMP option traders, I want to walk you through the 111 trade, which is at its baseline a short put strategy that has a hedge involved with it. This way we can make money like normally selling puts, but we'll also have that downside protection in case a crash does occur. And that is great for people who not only want the consistent income of the puts, but also want to limit risk. And now again, this is the baby brother to the 112 trade that I'll be covering in the next lesson. But this 111 trade is a great place to start off with, especially if you have a smaller account. So how is a 111 structured? Well, at its base, it is selling a put. So we're going to sell a put at a certain level, meaning that we hope that the stock stays above this level. This makes money as long as the stock stays above it. So if it goes up, we make money. If it goes sideways, we make money. If it goes down, but stays above our level, we'll make money. So at the baseline, this is a super profitable strategy. But not only do we have this put that we sold, but we also create a put debit spread closer to the stock price. What in the world is a put debit spread? Well, a put debit spread is structured like this. Oops, didn't mean to do that. It's structured like this, where we buy a put and then sell a put. And this put debit spread makes money as the market goes down. So that means that how we have this trade going is as the stock goes down, this put option here will go down, we'll lose money, but this put debit spread will make money. So this will help us slow our losses, and slowing our losses is good because as long as the stock stays above this level, we make money. And so now in the in-between, our profit and loss, as we're waiting to realize that profit at expiration, will be mitigated, will slow down, we'll have less of a downside risk because of this hedge we have. And again, this is how I structure this trade so that you guys know exactly what's going on here. We structure the trade by going 90 days out like usual. This eliminates gamma risk. This has a good theta decay, and it also allows us to collect a decent amount of money. So 90 days out, we have the 10 delta put just like we did when we sold the put, but we're also going to have a 30, 28, oops, that's not what I meant to do, 30, 28, that's a 2, 28 put debit spread. And again, this is going to be a trade where I'll actually walk you through how to place it on a broker because it can be a bit complex, but it's structured like this. And then we're targeting a 75% profit target, which means we're holding a lot longer, but we're collecting a lot more money. And we have the same 400% stop loss. So 400% stop loss, stop loss, and 75% profit. And so again, this means that if we collect $1,000 for this trade, we take profit at $750. If we collect $1,000, then we're going to stop out at a $3,000 loss. And so this is how we structure the trade. This trade has about a 95% win rate, but again, don't take my word for it. Let's walk through the back test. Here's the back test on eDelta Pro if you want to back test this for yourself, but this is how it's structured. Just as I said, 10 days, a 10-year back test. We have the 10 delta put that we sell. We have the put debit spread that we create here by buying the 30 delta and selling the 28 delta. We go 90 days out. We have a 75% max profit and a 400% stop loss. This gives us a profit over 10 years of almost $2 million. Guys, that's an insane profit, $2 million. Now again, this return on capital, 82%, is incorrect because again, it doesn't factor in some stuff here. This is taken as one trade and this is one trade. So the buying power is equivalent to that of selling puts. So that means that we're kind of like doubling our return, right? Because we're making a huge return, but we have the same buying power as selling puts. So we're making actually about a 40 to 50% return a year just trading these 111s. What else about it? It has a 35-day average duration. That means it takes about a month for you to realize profits on this trade. So that means it's going to take a month to put this trade on. So although you make a lot of money, about $790 for your winning trades, you're going to have to hold them for a month, which is fine, right? Because if you're making 75% on your money, that is a great return, right? And so again, that's kind of what we're targeting there. You can see here it's a very smooth and consistent uptrend, unlike before when we saw the selling puts. It was a bit more wild here, but again, this hedge right here helps prevent this. Now, what I do want to highlight is, yes, this works. That's the same pitfalls is during crash periods that it underperforms, right? So if we see here, comparing it to the market, it underperforms when the market crashes here, the market crashes here, and the market crashes here. Don't worry, this is actually outperforming the market. The backtest just doesn't know how to treat a 1-1-1 order based on buying power. It thinks it requires more buying power than it does, which is why SPY is higher. But don't worry, this has the same profit graph as the short put alone. Okay, so that's what we're looking at there. Now let me drag in my broker here so that you can actually take a look at what's going on. So let me hide accounts here. So if we go into this, we're going to structure this exactly as I said. We're going to go target the 90-day level right here. We're going to sell a 10 delta put. So this one right here, we're going to sell this one. So here's a 10 delta put. We're going to sell it. This is going to bring in a $1,112 profit. Then we're going to do the 30. We're going to sell the 30 and buy the 28. This creates a put debit spread. This is a $5,000 buying power, almost exactly what it would be as if we're just normally selling the put, but now we have downside protection. So let's take a look at what this actually looks like. So when we bring up a curve, the curve will show us what our profit will be at expiration. So if we see what our profit will be like at expiration, it looks like this. When we're selling a put, we have a single consistent profit, but with this put debit spread, we now have this hedge here. And how this works is once we get to our profit that we're trying to target, then from there, we're able to actually take off this put, take our profit, and leave on the hedge. So what does that look like? Well, let's say we put this trade on, we make the 75% profit in roughly a month. What we're going to do is most of that profit is coming from the short put. So we're going to close that short put, lock in our profits, and we're going to leave on this downside hedge. What in the world does this downside hedge do? This downside hedge gives us a $1,000 profit to the downside, which means that if the market drops down, we're going to make about $1,000. And why is this great? Because when we leave this hedge on for the rest of our trade, then this means that any other 1-1-1 trades, any other short puts, any other strangles that loses money because of the market dropping will be mitigated because we have this $1,000 hedge on that will make $1,000 when the market drops. And so that's the beauty of keeping these hedges on, is that it helps offset losses from any other short trades that we have on, like selling puts, selling strangles, 1-1-1s, and other 1-1-2 trades. Another way to structure a hedge on this trade is simply, instead of selling the 10 delta put, we sell the put that is attached to this put debit spread. We sell this put right here. If we sell that, it creates a larger type of put debit spread here. But again, this is a put debit spread that when we put it on, we'll actually have a bit of a loss because we don't have enough profits to cover it. But this will give us a $16,000 downside protection. So why would you want to take a small loss to turn your 1-1-1 into this type of hedge? You'd want to do that when the market is near its crucial levels, meaning that it's hitting or breaking this blue line. Right now, it's not hitting it, but when it does, we tend to see these pullbacks. When it does, we see huge crashes, especially when it stays above it, right? When it stays above these levels. Then we have these huge crashes. So if we're at or near these blue line levels, then we can convert our 1-1-1 into a larger hedge, which could then give us $16,000 of a downside move, which can cover any and all losses we have from any other trades. All right, guys, this is the 1-1-1 trade. If you want to automate it, we're going to do the same thing we've done before. We're going to create a new auto trader in our beta system here. I'm going to log into my Tastytrade account. After I have successfully connected my account or verified it, then I'm going to create the strategy. I'm going to go right here to the 1-1-1 strategy. I'm going to structure it exactly as we did. We're going to have a that's the put debit spread. So the put debit spread is a 30 delta that we're buying, a 28 delta that we're selling, and we have the 10 delta put. So this is what it looks like to structure the 1-1-1 trade. We can do it on MES if we don't have a large account, or ES, whatever one we want to do. Weekly on Wednesdays. We're going to target the 90 days until expiration. We're going to have a 75% take profit target. We're going to have a 400% stop loss. And when we do a 1-1-1 or a 1-1-2 strategy, we can turn it into a hedge. And so I want to turn it into the PDS hedge, which is where I'm going to close out these short puts, and that creates this hedge. And so again, if I don't want to turn it into a hedge when the trade is done, I can just close the entire trade by keeping it on place select. If I want to turn it into a hedge, I just click on what hedge I want to turn it into. And at the end, once I've hit my profit, it will turn it into this hedge for me. So now I can hedge my positions and take profits automatically, which is decades and eons above what most brokers are doing right now. So that's why this auto trader is amazing. I set my buying power allocation. I want to enable it to avoid market crashes so that I don't get in during market crashes, and I also get out before them using our systems. And just like that, I've created an auto trader for the 112 trade on the MES. So I have a right here an Austin Booley 111 trade MES, 30 put, 28 put, 10 put delta, 400% stop loss, 75% profit. That is how I set up this auto trader. Now I will automatically put on this short put strategy that also has a hedge, so I can prevent any downside risk. I can make good money, and this trade takes roughly a month to put on, but still I make a great amount of money for the risk that I'm putting on. Anyways, guys, I hope you enjoyed this video, and I'll see you in the next one.